We often start these investment discussions with this underlying assumption that you need a lot of capital, that you have to be rich to get richer. But today, we are really tearing that playbook up. Our mission here is to dig into a surprisingly aggressive strategy that's built around one very accessible number, $1,000.
That's right. For today's deep dive, we're looking at the 2026 $1,000 survival blueprint. And the source material is all focused on helping people escape what it calls, pretty bluntly, the cash trap.
The cash trap, I like that.
Yeah, and the goal isn't just, get rich quick speculation.
Yeah.
It's about applying real institutional grade diversification, even if you're starting small.
Okay, let's get right into that framework because cash trap is it's an aggressive term. It suggests that just holding cash, the one thing we're all taught is safe, is actually hurting you.
It is.
So what's the immediate macro threat that makes this so urgent?
This is really the punch in the face that the blueprint starts with. It points directly at currency devaluation. The argument is that holding $1,000 right now is like starting a race 100 yards behind everyone else.
Okay.
I mean, just look back at 2025. The U.S. dollar lost something like 10% of its purchasing power. And the sources we're looking at suggest that for 2026, the Fed's quiet printing is only accelerating that.
Quiet printing. That sounds almost a little conspiratorial, but it's a real mechanism. Can you define what that actually means for someone with $1,000 in the bank?
Yeah, absolutely. And it's not about, physical money being printed. It's about how the Fed expands its balance sheet, how it manages liquidity, especially with tools like the repo market.
So it's more subtle.
It's very subtle. They expand the money supply to keep things stable. But the knock-on effect, the consequence, is a silent devaluation of every single dollar you hold.
And from a strategic realist view, that's just a mathematical certainty.
It's undeniable. If your $1,000 is sitting in a standard savings account, earning maybe, 0.05% interest, that 10% inflation rate means you are guaranteed to lose over $100 in real purchasing power this year. It's just capital erosion while you sleep.
Which completely reframes the idea of savings.
Yeah.
So the goal here isn't speculative growth, not really. The primary mission, according to this blueprint, is building ownership.
Exactly.
You're trying to survive inflation by swapping that cash for something real, something foundational.
Precisely. If cash is guaranteed to lose value, you have to convert it, turn it into assets that hold or, ideally, grow their value. And that brings us to the first pillar of the blueprint, which is all about betting on the innovation engine itself.
Right, and the blueprint recommends something specific here. It says to avoid the really well-known one, QQQ, the standard NASDAQ 100 tracker, and instead swap it for its younger sibling, QQQM. So what's the thinking there? Why that choice for innovation exposure?
The thesis is actually pretty simple. You're betting on what the material calls the innovation operating system of the planet. QQQM gives you the exact same exposure to the biggest non-financial tech companies on the NASDAQ.
The big names.
The biggest names. And critically, for any modern portfolio, you get that essential NVIDIA, Apple, Microsoft trifecta without having to place a really high-risk bet on just one of them. You're buying the whole ecosystem.
That exposure is powerful, no doubt. But from the strategic realist side, why QQQM specifically? I mean, QQQ is way more liquid. Everyone knows it. And like you said, they're basically the same product.
Right.
For someone with just $1,000, does the ticker symbol really matter that much?
Oh, it matters intensely, especially when you're focused on optimization and efficiency from the very start. This is where you have to apply that financial rigor, even to the smallest portfolio. You have to scrutinize the cost.
The expense ratio.
The expense ratio, we're talking to basis points. And for a starter portfolio of $1,000, every single basis point is a tiny fraction of a share you're either borrowing for yourself or just giving away to the fund manager.
And QQQM is cheaper. How much cheaper are we talking?
It's meaningfully cheaper. QQQM's expense ratio is 0.15%. QQQ's is higher. Look, when you're trying to maximize a small amount of capital, you have to be ruthless about minimizing any kind of drag.
So if you're trying to squeeze every last cent of ownership out of that $1,000, QQQM just lets you own a fraction more from day one. It's purely an optimization move.
Exactly. Think of it like a tiny sales tax on your coffee every single day. You don't feel that extra 5 cents at first, but over years, those tiny fees just compound against you. It teaches the right principle from the start.
Yeah.
Every cent of fees matters.
Okay, that makes perfect sense. And it moves us nicely from broad performance to pure strategy. So let's go from that high-octane growth engine to the financial insurance policy, the foundation. This is Deep Dive Section 2, Systemic Stability. And we're starting with the plumbing. JQ Morgan, JPM.
JPM is presented here as the ultimate defensive play in the financial world. I mean, the scale is just enormous. They have something like $4.6 trillion in assets. They're not just a bank. They are the literal financial plumbing of the global economy.
They're completely intertwined with the system.
Exactly. So this pick is all about building a foundation that is, frankly, too big to fail. It's the stability anchor in this whole blueprint.
I get the safety argument. They're huge, they're regulated, they're stable. But here's the challenge from the optimistic investor side. JPM is an elephant. It's massive. For someone starting with $1,000, why bet on something that might be inherently slow? They need lift to beat that 10% inflation risk.
Yeah, but that's where the blueprint reframes instability as an opportunity. The analysis suggests that volatility is actually JPM's growth mechanism. Well, as interest rates stay high and, volatile, smaller regional banks are under enormous strain, JPM, with its fortress balance sheet, meaning just massive cash reserves, is perfectly positioned to acquire those smaller, failing banks.
At a discount.
At a steep discount.
Yeah.
So their stability isn't just a defensive shield, it's an offensive weapon. They use their strength to consolidate the market while everyone else is panicking.
So they actually get bigger and more dominant during economic turbulence.
Precisely. They have the capital and the regulatory green light to step in when others fail. So for this strategy, their size translates instability into actual accretive growth.
Okay, that connects the defense to an opportunistic engine. I like that. Now, let's pivot from the financial infrastructure to the physical infrastructure. The stuff that powers all that tech we bought in QQQM.
Right.
We're talking about Taiwan Semiconductor, TSM. And this is where the source material uses a great analogy. The stage versus the rock star.
Yeah, it's a perfect analogy. If a company like NVIDIA is the rock star, getting all the media attention, the huge stock run-ups, then TSM is the recording studio.
And the studio gets paid no matter which artist has the hit song.
Exactly. It collects rent and production fees regardless of who's topping the charts. The demand for that physical chip-making capacity is constant, no matter who wins the AI race this year or next year.
The numbers on this are pretty staggering.
They are. The core fact here is that TSM produces over 80% of the world's most advanced chips. You physically cannot build modern AI clusters, high-end servers, advanced EVs, or sophisticated defense systems without their fabs. It's impossible.
That sounds like a natural monopoly, which is a term the blueprint uses. But let's get to the elephant in the room, the strategic realist question. Doesn't this concentrate massive, catastrophic risk in one very, very volatile geopolitical region?
It does, and that is the most critical piece of this puzzle. The blueprint argues that while the geographic risk is absolutely real, the political necessity of the product itself creates a kind of shield.
Meaning the world can't afford for it to stop production.
Correct. The U.S., Europe, Asia, everyone relies on those advanced nodes for their economic and military futures. That reality changes the political calculus. The need for their product, in a strange way, transcends the immediate geopolitical tensions. It's a non-replaceable asset, and that's what protects your investment.
Okay. So far we have innovation with QQQM, financial plumbing with JPM, and the physical manufacturing bedrock with TSM. It's a pretty balanced portfolio.
Yeah.
Now for the final pillar, the defensive shield. We're looking at the Healthcare Select Sector SPDR ETF, which is XLV.
Right, and this final piece is all about finding a sector that has absolute, just bulletproof pricing power.
And healthcare is defined by that non-negotiable demand. I mean, this is probably the simplest thesis in the whole blueprint. People might put off buying a new iPhone, but they are not going to skip their insulin.
Never. But what's really interesting is why XLV is positioned as the 2026 edge. It's not just about stability. The blueprint points to two huge macro drivers that are pushing this sector into a growth phase.
The first one is demographics, right? An aging global population. That just guarantees sustained long-term demand.
Exactly. And the second is the current boom in breakthrough treatments. Think about the whole Ozempic-style weight loss drug phenomenon. It's driving enormous revenue through giants like Eli Lilly and Novo Nordisk, which are both huge parts of XLV. This isn't just stability anymore, it's secular growth.
So that combination of non-discretionary spending and real medical innovation makes it almost totally resistant to inflation.
It does. The companies in XLV can pass rising costs directly on to consumers or insurers because their products are non-optional. That gives them absolute pricing power, which makes XLV a perfect active hedge against that quiet printing threat we started with.
And that completes the blueprint. We have 5 pillars for that starting $1,000: innovation, a financial fortress, the invisible stage, and the defensive shield. It's a strategy that consciously gets you out of the cash trap.
Which brings us back to the most powerful conclusion of the source material. The ultimate message here is all about consistency over perfection.
Meaning you can't just sit on the sidelines waiting for the perfect moment to invest or for the perfect amount of capital to start with.
Absolutely not. The core thesis is that starting with $1,000 today is fundamentally and mathematically better than waiting to start with $10,000 next year.
Because while you wait,
While you wait to save that extra $9,000, your current $1,000 is actively losing purchasing power. Time in the market will always trump timing the market, especially when currency devaluation is accelerating. The cost of delay isn't zero, it's 10%.
so waiting isn't just passive, it's actively corrosive to your capital.
If you're losing 10% a year, waiting 1 year costs you $100 off that initial 1,000 just to break even. This blueprint is about taking action. It's about building ownership immediately as an act of financial defense.
So here's the final thought we want to leave you with, building on everything we've unpacked today. If cash is actively losing 10% of its purchasing power every year because of things like quiet printing, how does that fundamentally change the way you look at the next $1,000 that hits your bank account? Does it stay in savings, or does it become capital that demands immediate deployment into ownership? Think about that distinction: savings versus ownership, because it might just change everything about your own survival blueprint.